Hey, welcome back, everybody. Welcome to all of our new traders. I see we've got quite a few who have joined. It's great having you here. And one of the topics that comes up a lot is about tracking complex trades. And by complex, I mean that you've got multiple legs to them or embedded parts. You might have, let's say, multiple vertical spreads in a butterfly spread or multiple butterflies within a butterfly. And sometimes some of these embedded parts can start reaching maximum gains. And when that happens, there's no reason to continue holding it. That becomes what we call a danger. It really can't help you anymore, but it could certainly hurt you. And what we need to do is to spin that out of the account without shutting down the entire position. But then the question becomes, what's remaining? What does my risk graph look like? And that's what I want to show you here when you are tracking complex positions. So let's go have a look. And as always, before we do, please be sure to click like and subscribe. Very much appreciated and goes a long way into promoting the channel. So complex trades. Remember that some strategies may provide opportunities for multiple purchases and sales. They've got lots of legs, lots of strikes to them. We don't have to open it as one trade and shut it down as one trade. We might open it as one and peel off some of the parts, or we might leg into it, take some of the smaller pieces and build a more complex position. But that means we have lots of things to trade if you know where to look. And this is where a lot of the opportunities lie that most traders miss. So again, if one position is close to the maximum gain, it pays to close it, but leave the remaining positions open. But the question that we're trying to address here, how do you track it? How do you figure out what you have left? Now, sure, most of your fancier platforms like thinkorswim or E-Trade will show you a risk graph, and you can do some hypothetical trades in there and see what's going to be left or what's going to remain. But let me show you an easy way to sketch it out. So for instance, let's say that we buy the 100, 110, 120 butterfly. And to do this, you're going to buy one $100 call. You will sell two of the 110 calls, that's the center strike, and then you will buy one of the 120 calls. This would be a long butterfly, and let's just say that it's executed for a net debit of 2. Now this is also a 10-point butterfly. That's just the difference between these outer strikes, difference between 100 and 110, or between 110 and 120. They're just two vertical spreads. So if they're 10 points wide and we paid 2, the maximum gain is 8. But the question is, how many butterflies do we have? And most traders would say, well, a 1-to-1 ratio is one butterfly. That's one way of looking at it, but there are better ways, more complex ways. So for instance, here's the 100, 110, 120 strikes. Let's say if we buy the 100, sell two of the 110s, and buy the 120, this is the resulting risk graph. There's our bend at 100, there's our two short 110s, and here's the long 120. We paid $2 for it, maximum gain is 8. That's what we just saw. However, there are also smaller butterflies in here. There are embedded butterflies. So watch this. If we have one of these spreads, this 100, 110, 120, mathematically I also have one of the 100, 105, 110s. I have two butterflies at the 105, 110, 115 strikes, and then I have one at the 110, 115, 120. Now sometimes traders find this hard to believe. How could you have 4 of these smaller butterflies inside of a larger one? Well, take a look at it mathematically. Let's look at the 100, 105, 110. There's one butterfly, our 1-to-2-to-1 ratio. For the 105, 110, 115 strikes, we had 2 butterflies. That's a 2-4-2. And then the 110, 115, 120, again, is a 1-to-2-to-1 ratio. Those are all long butterflies. So take a look at what happens. These cancel, and these cancel, and what are we left with? Well, we've got one call over here. Here we've got 2 in green, minus 4 is -2. And then on the far right, at the 120 strike, we also have +1. So there's our 1-to-2-to-1 ratio at the 100, 110, 120 strikes. So mathematically, I could have created the same spread by buying this butterfly, buying 2 of these, and buying this. So they do exist. They are actually subparts of this bigger butterfly. And so here's what they look like. And to show that it actually works, not just conceptually, but if we put this into a pricing model, the 100, 110, 120 butterfly was priced at $3.86. But let's take a look at the blue one down here. The 100, 105, 110, according to a pricing model, is 94 cents. Buying two of the 105, 110, 115s, they were priced at $1.03 each. And then the 110, 115, 120 was 86 cents. So if we add up these right here, this blue, the two reds, and the green, we get $3.86, exactly the price of the bigger butterfly. So they are there. It's mathematically equivalent. So the thing is, if you are holding this larger butterfly in black, you could trade these smaller butterflies in here. So let's say this 100, 105, 110 starts to get close to maximum gain, or for some other reason and you want to shut it down. You don't need to close the entire spread. Just close that one. But now it's going to change the structure. What else do we have? So here was the setup that we saw before. And if we sum these up, we would get the 100, 110, 120. But watch what happens if we just close this first row down. That's completely gone. Those trades are gone. We would just simply sell that butterfly. We're left with these. But what is that? Well, this is what you do. You just continue to sum things vertically. Sketch out your original position and then start crossing off the things that you're closing or adding. So here we've got two calls at the 105 strike. I have -4 plus 1, that's -3 at the 110. At the 115 strike, we have +2, -2, we have 0. And at the 120 strike, we have +1. So notice that I have net contracts of 3 long. I've got 2 plus 1, and I also have -3. So on a net basis, we don't have any positive deltas or negative deltas out into the wings. But we do have some in between here. So what are we holding? We've got a 2 by -3 by 1 at the 105, 110, 120. Well, let's say that we close this out by collecting a buck. This would be the resulting risk graph. So we used to have $2 into it. Now we've got a buck. But notice that we have 200 deltas on this side. That's what we saw in the previous slide. So it looks a little lopsided. It looks like this V part is leaning to the left. And that's because we have more deltas here on the left-hand side, positive deltas. We've only got -100 on this side. But because we've got -100, we're skipping a strike, we're still going to lose 10 points here. So again, that can be a little confusing. If we look between 105 and 110, that's 5 points, but we've got 2 contracts. So 5 times 2 is 10 points, minus the dollar we have into it is 9, and that's the maximum gain. Now, if we have $9 into it and we are losing 10 points, that's the difference between 110 and 120, but on one contract, or 100 deltas, that's 9 points up here, minus 10 gives us -1. So it is balanced. This is actually what's called a ratio butterfly, but the maximum losses are the same. Well, what if we had maybe the center butterfly? Maybe we only want to close one down. So we go back to our original position. This is just what you sketch out on paper. What happens now? We're only going to close one of these. So it should leave us with a 1, 2, 1 butterfly. And so there's that. When we close that down, it's a credit. Let's assume that we get a $1 credit. What remains? So take a look. We just sum everything up vertically. We still have one contract long here at the 100 strike. We have -2 plus 1. That's -1 call at the 105 strike. Here we've got 2 in green, -2, that's 0. Over here we have -2 plus 1 is one short contract at 115, and then we have one long contract at 120. So if you understand your risk graphs, you can see that that is a condor. And so we're long this left wing, short the 105, we skip the 110, we're short at 115, and then we're long again at 120. Another way to see that we have no deltas at the extremes, we are long 2 contracts and we are short 2 contracts. So that's how we know, just by looking at this, that we don't really have any major risks at the far left or right sides of the graph. So if we were to graph this, this is what it looks like. And it is, in fact, a condor. We have 100 deltas out here on the left. We have -100 out here on the right. So again, that's a fairly simple technique that you can use to just sketch things out. Now, many of you might even be able to do those in your head or just with a very light sketching and be able to figure out. But that was only one butterfly with 4 embedded butterflies. But what if we had something like this? Now they're 20 points wide. Now look at this. We end up with one butterfly here, two different butterflies here, three there, four here in the center, and then 3, 2, 1 out here. That's 16 butterflies that you potentially could manage. And that can start to get very complicated. Unfortunately, what do most traders do when things get complicated? They just shut the whole position down and start over. And that is really missing some of the best opportunities, assuming you know where to look. It's really the best way to make the most of the complex strategies and to manage risk as market conditions change. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.